What if I told you a company worth $60 billion could vanish in 60 days? In the heart of Wall Street, Lehman Brothers was a titan, a symbol of financial prowess. Founded in 1850, it had weathered the storms of the Great Depression and numerous recessions, standing firm as a pillar of the American financial system. Yet in 2008, it collapsed under the weight of its own ambition, triggering a global crisis that would resonate for years to come. The story begins with Lehman Brothers' aggressive investment in mortgage-backed securities. As the housing market boomed in the early 2000s, so did their profits. The firm, under the leadership of CEO Richard Fuld, embraced the burgeoning subprime mortgage market, seeing it as a gold mine. Mortgage-backed securities became the cornerstone of their success, and by 2007, they held approximately $85 billion in mortgage-related assets. But the seeds of their downfall were sown in the very strategies that fueled their rise. By 2007, signs of trouble emerged as the subprime mortgage crisis took hold. Homeowners began defaulting on their loans at unprecedented rates, and the housing bubble started to burst. Lehman Brothers was heavily exposed to failing mortgage assets, and the cracks in their empire began to show. Richard Fuld, known on Wall Street as the Gorilla for his aggressive risk-taking, was adamant that the firm's strategies would prevail. His refusal to acknowledge the precarious position Lehman was in would prove catastrophic. In the shadows, CFO Aaron Callan was implementing Repo 105, a controversial accounting maneuver that temporarily hid $50 billion in liabilities. This tactic allowed Lehman to paint a rosier picture of its financial health, misleading investors and regulators. It was a house of cards built on the illusion of stability, and it was beginning to crumble. March 2008 marked a turning point when Bear Stearns collapsed, serving as a harbinger for Lehman's fate. Despite this warning, Lehman continued to operate under a facade of stability. The Federal Reserve and Treasury Department, aware of the looming danger, were criticized for their inaction. The Bear Stearns bailout had set a precedent. Yet as the summer of 2008 waned, Lehman's stock price plummeted, losing nearly 73% of its value by September. Panic ensued. Investors fled, triggering a liquidity crisis that the firm could not withstand. On September 10, 2008, rumors of instability swirled, and Lehman's stock price nosedived. The writing was on the wall, yet Lehman remained defiant. Richard Fuld, in a last-ditch effort, sought a lifeline. Talks with potential saviors like Bank of America and Barclays failed as they saw the firm as too toxic a gamble. Fuld's desperation was palpable, his empire slipping through his fingers. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection, marking the largest bankruptcy filing in U.S. history with over $600 billion in assets. The news sent shockwaves through Wall Street. The New York offices were eerily silent as employees packed their belongings, the reality of their situation sinking in. It was a day that would be etched into the annals of financial history. The aftermath was immediate and severe. The Dow Jones Industrial Average plummeted 4.5% the following day, the largest one-day decline since September 11, 2001. Panic spread through the global markets, leading to a financial crisis that reshaped economies worldwide. Banks stopped lending, credit markets froze, and the ripple effect reached every corner of the globe. The human cost was staggering. Overnight, approximately 26,000 Lehman employees lost their jobs, joining millions more worldwide as the financial crisis deepened. Stories of shattered dreams and lost livelihoods emerged, painting a picture of the human toll behind the numbers. The total cost to the U.S. economy was estimated to exceed $22 trillion, with countless lives upended in the process. The collapse of Lehman Brothers was a significant catalyst for the global financial crisis, leading to widespread economic downturns and the eventual bailout of other financial institutions. Analysts argue that with better regulatory oversight, the catastrophe could have been averted. The root cause of Lehman's downfall was a toxic cocktail of excessive risk-taking, poor regulatory oversight, and a reliance on complex financial instruments that were poorly understood. Their aggressive investment in subprime mortgages and the use of accounting tricks to obscure their financial state led to a catastrophic loss of confidence. The story of Lehman Brothers is a stark reminder of the consequences of unchecked risk and the importance of transparency in financial reporting. It reshaped the landscape of global finance and continues to serve as a case study in corporate governance and crisis management. In the aftermath, governments around the world were forced to reevaluate their financial regulations, leading to the implementation of measures such as the Dodd-Frank Act in the United States. In the end, Lehman's collapse is not just a tale of financial ruin, but a lesson in the vulnerability of systems built on fragile foundations.